Hello and welcome to the Daily Brief by Zerodha. Here we cut through the noise and bring to you the most important pieces of news that move the markets. I'm your host Anurag Bansal, and in today's episode we'll talk about 6 very interesting stories. First, we'll talk about the Indian mutual fund industry and see if Indian investors chase value or returns. After that, we'll talk about Zomato's new platform fee and what it means for the company and its shareholders. In the third story, we'll speak about what different state governments are doing to protect gig workers in India. Post that, we'll talk about Apple's sales growth in India and their Make in India plans. Fifth, we'll look at credit growth in India and what RBI is really up to. And finally, we'll talk about the latest data on India's trade deficit. So let's begin with something interesting happening with mutual funds. See, mutual funds usually keep a part of their assets under management or AUM as cash. In the case of AMCs, they hold about 5%. Currently, equity mutual funds also hold about 5% of their AUM in cash, which is the lowest level in 5 months. Now here's the thing, high cash levels often suggest that fund managers are being cautious or cannot find good investment opportunities. So when cash holdings drop, it usually means that fund managers are feeling pretty good about the markets. But it's weird when you consider the current market levels. See, Indian markets have been on a non-stop upward trajectory ever since COVID hit. Many experts have been saying that the markets are overvalued and some segments are also in a bubble. So the question here is, does the fall in cash holdings mean that fund managers are ignoring valuations? Maybe not quite. Look, being a fund manager isn't really easy as you would imagine. If they keep too much cash, they might miss out when the markets shoot up. And if they don't keep cash, they are more exposed when the markets fall. So here is something to think about. Are Indian mutual fund managers really value investors, or are they just chasing returns? Maybe a closer look at the portfolios of the funds you have invested in could give you your answer. Now moving on, let's talk about Zomato. See, Zomato recently raised its platform fee from 5 rupees to 6 rupees in some metro cities. This is the 5th increase since it was first introduced in August last year. Now if you're wondering why, it's probably because Swiggy started charging a similar fee back in April 2023. Considering food delivery is a duopoly between Swiggy and Zomato in India, it was relatively a simple way for Zomato to increase its revenues. Now Zomato also had the option to keep the platform fee at 0 rupees and use this as a way to attract users from Swiggy. But why it was a hard call is because of two main reasons. First, Zomato is a publicly listed company. This means it has to keep its shareholders happy. And these shareholders expect to see profits grow consistently. And second, the upcoming IPO of Swiggy adds another layer of pressure on Zomato to maintain competitive pricing strategies and keep its investors happy. Now, because this is a market with just two players, Zomato and Swiggy enjoy a significant pricing power. This means they can comfortably raise their prices without worrying about losing too many consumers. Long story short, people don't quite have a choice. Now this is not just an Indian thing. Global companies like DoorDash and Uber Eats also charge a platform fee. They just call it using a different name, which is service fee. Now speaking about the platform fee, Zomato's management had earlier said that the introduction of platform fee has greatly helped their revenue along with better ad monetization. The CFO of Zomato, Akshant Goyal, also mentioned that the company believes that the platform charge currently is too small to affect consumer behavior. He said that Zomato might keep experimenting with the fee amount, but they are not really planning to get rid of it anytime soon. Now if you're curious about how much money Zomato can really make through this 6 rupee fee, let's do some quick and dirty math. With about 22 to 25 lakh orders every single day, a 6 rupee platform means that Zomato makes close to 1.5 crore rupees every day. That's about 45 crores a month and 550 crores a year. That is some big money to let go of. Now moving on, now see, in many of the previous stories, we have discussed India's youth unemployment problem. About 50% of India's population is aged between 18 to 44, and a major unemployment problem is troubling this age. This problem is mainly because of skill gaps as well as pay disparities. Now, one space that is really rewarding skills and hard work with good pay is the gig economy. According to Niti Aayog, there are over 2.5 crore gig workers in India, which is crazy considering that these gig platforms didn't really even exist a few years back. But considering the fact that these platforms are growing rapidly, these numbers are bound to be higher in reality. According to BCG or Boston Consulting Group, the number of gig workers in India could increase by 5 to 10x and reach 90 million in the next 10 odd years. Now, according to a data from 2021, most gig workers in developing countries like India were younger than 35 years. This means these people are finding it hard to get well-paying jobs. But here's the thing, it's not all nice and rosy. As of late, there has been some growing concerns about the gig economy. These jobs don't really classify workers as employees. This means there is no job security, there are no benefits, wages are irregular, and employment status is uncertain. And this uncertainty has been causing a lot of stress for these gig workers. To solve this, the Indian government has classified gig workers as unorganized workers. This means they are eligible for some social security benefits. In July 2023, the Rajasthan government was the first state government to introduce a bill to protect gig workers. Recently, the Karnataka government has also followed the same footsteps. They recently introduced a draft bill to provide social security and welfare for platform-based gig workers. The bill proposes a few important things for gig workers which you should know of. First, all digital platforms and gig workers need to register with a new welfare board within 60 days. Second, the government will set up a welfare fund for registered gig workers. Third, platforms need to provide fair contracts and 14-day notice for terminations. Now again, while all of this might be intended to be a good move, there are some concerns that people and journalists have highlighted. First, the bill still does not solve the main problem, which is it still does not call gig workers as employees. Instead, it still treats them as independent contractors. Because of this, they will still miss out on many important benefits that an employee would otherwise have gotten. Second, the bill talks about welfare fees, but it does not say who will pay for them. Companies or customers, we don't quite know. This could affect how much gig workers end up earning in India. Third, the bill does not really talk about what companies should do if customers misbehave with workers. It's silent on these kind of important issues. So while the bill tries to help gig workers, it leaves a lot of important questions unanswered. But the good news is that Karnataka's bill is still a draft, which means multiple changes can be made before it is finalized. Moving on to the next story, let's talk about Apple's sales growth in India. Apple, which is the biggest company in the world in terms of value, recently hit a massive milestone in India. They made $8 billion in annual sales, which is a 33% jump from last year's $6 billion. Now $8 billion sounds huge for India, right? But for Apple, it is just a very small drop in their ocean. 8 billion is only about 2% of their total global sales of $380 billion. But all said and done, India is one of their fastest growing markets, and that is why they're also looking to make their iPhones in India. But over here, let's take a small step back and talk about how Apple started making its phone in India in the first place. See, for years, Apple heavily relied on China for assembling their products. But with all the US-China tensions rising, Apple decided to diversify a little, both in terms of sales and their production. That's exactly where Foxconn entered the scene. Foxconn, by the way, is a Taiwanese company that makes electronics for almost all major companies, including Apple. Foxconn has been investing heavily in its iPhone factory in Tamil Nadu, but things haven't quite been very smooth sailing for them. For starters, they're incurring higher costs for materials. Second, there are more defective phones in India than in China. And third, they even had to bring Chinese engineers to India to train the local workforce. Now if you're wondering why, it is because Foxconn is facing difficulties due to cultural differences and the lack of familiarity with high-tech electronic manufacturing among the Indian workforce. Now you remember how we've been talking about the lack of skilled workers in India? This is a perfect example of it. But here is where things get interesting. Tata Electronics has recently jumped into the Apple supply chain. They recently set up a plant in Hosur, Tamil Nadu to make iPhone casings and are buying Wistron's iPhone manufacturing business in India. This strategic move has allowed Tata to quickly scale up its manufacturing capabilities without setting up a new factory from scratch. This is all a part of India's push to attract manufacturing companies. The government has a scheme called the PLI, or the Production Linked Incentive. In simple words, it's the government's way of saying, hey, come and make stuff in India and we'll give you some financial perks. And this seems to be working pretty well. Ever since the scheme started, India has attracted over 1 lakh crore of investments. Apple CEO Tim Cook even mentioned in a recent earnings call that they are now focusing on various aspects in India, from developers to markets and operations. Hopefully soon we'll see more global giants making India their home. Let's now talk about something interesting that is happening in the world of bank lending in India. The RBI recently released its credit growth data, and there are some fascinating trends to look out for. But first, for context, credit growth data shows how people are borrowing and how banks are lending. Now before we get into the details of this, let me give you some background. See, before the pandemic hit, credit growth was pretty much very weak. In simple words, banks weren't quite lending too much. But post the pandemic, credit growth has been spectacular, especially in personal loans and in credit cards. RBI's latest data reveals some very interesting insights. Overall credit growth is at 16% year on year. For comparison, it was just 6% in July 2021. This shows the total money lent by banks across all categories. But after hitting a peak in December 2023, it has been pretty flat. Second, personal loans are growing at about 18% year on year. But there is something interesting happening here. In November 2023, the RBI increased the risk weight for unsecured personal loans and credit cards. This means banks had to set aside more money for every rupee they lend in these categories. Now, why did the RBI do this, you might be wondering? Well, unsecured loans were growing too fast and the RBI got worried. So they made it more expensive for banks to give out these loans. And seems like it might be working. In November 2023, unsecured loans were growing at almost 22% year on year. But as of May, this growth has dropped to 17%. Now here is where it all gets really interesting. Banks seem to be shifting gears. They're reducing personal loans and instead giving out more agricultural loans. In November 2023, agricultural credit was growing at 18% year on year, and as of May 2024, it has jumped to almost 22%. Now you must be thinking, with all this money flowing into agriculture, the sector would be booming, right? Not quite. See, agricultural growth has actually fallen from high single digits to low single digits despite all this credit, which is very weird. But right now, there is no sign of stress in agriculture really. Bad loans are well under control and in fact have also fallen. Citibank research spotted something very interesting about this. They noticed that in 2008-09 and in 2015-16, when agricultural credit growth outpaced overall bank credit growth, it was followed by very tough times for banks that had given out agri loans. So now the big question here is, will history repeat itself? Well, only time will tell. Let's now switch gears and look at the latest data on India's trade deficit as part of our last story for the day. A trade deficit is an important piece of economic data that shows the health of the Indian economy. It tells you how much we are importing and how much we are exporting. This also flows downhill because imports and exports affect everything from the new phone in your pocket to the tomatoes in your fridge. Now, according to the latest data, India's goods trade deficit in June was around $21 billion, which was down slightly from the month of May. Now that sounds like a hefty number, but it actually shows some level of improvement, which is mainly thanks to lower oil imports. On the flip side, however, services like IT and consulting continue to bring home the money with a steady surplus of $13 billion each month. Now, when it comes to what India is shipping out and bringing in, June exports were about $35 billion. That is not bad, although we did see a slight dip from the month of May. Imports are holding steady at $56 billion with a mix of machinery and electronics and a bit less bling because of lower gold imports. Now, analysts from Kotak Mahindra Bank predict that India's current account deficit will stay at around 1.1% of the GDP for this fiscal year. Now that might sound like a financial jargon, but in simple words, it means imports might outpace exports due to strong domestic demand. Well, that's all the news I have for you today. I hope you found value in this. See you in the next one. Take care.